Hello everyone, and welcome to my next video on ratio analysis. In this video I'm going to be looking at return on capital employed, and for the return on capital employed we're going to need the operating profit and the capital employed. I'm going to talk about what capital employed is a little bit today, but if you're not sure about operating profit, you need to go back and have a look at my video on assessing financial statements, so looking at the profit and loss account and also recapping the balance sheet might be useful. So if you're not sure on those, go back and recap them. So yeah, return on capital employed. This is, sometimes it's called the primary ratio, mainly because businesses are most concerned with profit, or most businesses are. Obviously there are some exceptions to that. Return on capital employed is often referred to as the returns on the resources business has available to it, or how I like to explain it to my students as, it's for every pound that's invested in the business, how many pence do they make in return? And it can be defined by this equation. So operating profit divided by your capital employed times 100. So the components of that, as mentioned, the operating profit is found in the profit and loss account, and the capital employed is your total equity plus your non-current liabilities, and those are found in the balance sheet. So we're using both financial statements in order to construct the return on capital employed statistic. So let's have a go at calculating one. So I've got some statistics here that I've taken from a textbook from an example business. So we've got our non-current liabilities and our share capital and reserves. So these two combined make the total equity, and the non-current liabilities is the long-term debts which have gone into the business. So long-term loans, mortgages and things like that. All of that comes together to make our capital employed. So we've got some numbers here. Let's bring them together. So £360,000 plus £160,000 plus £420,000 will give us £940,000. Excellent. So that's our capital employed. And provided with that, we've also got the operating profit. So the profit after the cost of sales and the overheads have been taken away, but not before tax. Before tax, I should say. Yeah. Okay. So yeah, operating profits after the cost of sales and the overheads have been taken away. Okay. So let's put that into this equation. So our operating profit, 146,000, and then we're going to put 940 on the bottom. So yeah, 940,000. Multiplied by 100 gives us 15.53%, which means for every pound there is a 15% return on every pound that's been put into this business, or 16% if you're rounding up. So what's important about this is how you use it to compare it to other businesses and potential ventures. So let's come down to what this means. A high return on capital employed means resources are being used efficiently. So what that means is for every pound it's turning a bigger return. It means that it's a much more efficient business. The other thing you can do with this is that you can compare it to other business investments. So 15.53% would be very good if you compared it to perhaps your average annual ISA or savings account, which might have an interest of 1.8%. If you think about it, your return on capital employed is a much more this would be a much better investment. One thing to consider though is that there is always a degree of risk when you put money into a business. So you would expect your return on capital employed, it has to be much higher than the interest rate where your money isn't at risk. So yeah, you would expect this to be much higher in order for it to be a credible investment. It's important that another thing the return on capital employed is useful for is comparing businesses. So if you've got a number of different business ventures and you're trying to decide which one you might go to, you would consider what the return on capital employed is. Where can I get the best return on my pound? Obviously, there are other things to consider. Is that business looking to invest in the future that it might reduce your dividends? Is it a risky venture? Do you think the trend is going to improve over time? But yeah, certainly, you can compare businesses using the return on capital employed. Yes. And also you can use it to compare year on year. So if you've got a percentage that's increasing, ever increasing return on capital employed, that business is probably a very good venture, a good investment. If you'll see that percentage is falling over time, well, maybe if that trend's continuing, am I going to see such a good return on my investment? Probably not. Okay, so what other things that this means? The other thing is that it's useful for banks and shareholders. So the shareholders, as mentioned, they can compare the return on capital employed statistics to see whether an investment is a good venture or not. Alternatively, it may be good for banks because if they can see that a business has a high return on capital employed, it means that they will be more likely to be able to repay their loans. Also, if a business is trying to raise money to develop or to buy new capital and things, having a high return on capital employed may attract shareholders, and they'll be able to get a better share price when they're selling these shares on the stock exchange, raising money for future finance and things like that. Finally, the return on capital employed can be improved by a number of things. So we can do it by increasing the operating profit. So you might look to reduce your cost of sales or trying to reduce your overheads in order to increase the operating profit, which in turn will increase your return on capital employed. The other thing is you can reduce your capital employed whilst maintaining the profit levels. That might be slightly harder to do. So you might think about can you operate with a smaller factory and perhaps sell part of it? Can you pay off? Is the business in a position to pay off some debts? So reducing the non-current liabilities, which in turn would reduce the capital employed. So that's how it possibly can be improved. Anyway, I hope that's been a useful tutorial for you on operating profit. Really important thing is to be able to compare it to other businesses. Because the statistic by itself, without comparison, if the statistic seems around 20%, it may be considered to be very profitable, but you have to compare it to the interest rate, you've got to compare it to other businesses, you've got to compare it to the trends over time. Anyway, I hope that's been useful for you. See you next time.